Most investors spend all of their time trying to look for stocks that could 2x, 5x, or 10x in the future. What we don't hear talked about enough when it comes to social media and YouTube is people not talking about the fact that they need to find a way to protect their money. And in today's video, I'm going to be using live examples from my entire investing career over the past year on mistakes I've made, things I've done well, and mistakes that you can avoid when it comes to your investing portfolio. Because in my opinion, I believe that defense when it comes to investing is what's going to help you stay in the game for the long term. If you want to find small cap stocks early, but also learn how to protect your money, make sure you subscribe and hit the like button. And please comment below exactly what it is you would like to see in future videos, as I do respond to every single comment that comes my way. Now, why do I have QBTS pulled up? I just want to let you know that I have QBTS pulled up because it's going to be one of the stocks that we're going to be talking about today with a live example, because it's the first investment I ever made, and it did teach me some lessons. So the first mistake that I want to talk about is having too much money and too much capital into one specific stock. Now, why are we talking about for QBTS specifically? My first ever investment was roughly on February 25th, right here, zooming right there, February 25th. So I bought in somewhere between $5.92, anywhere from $6.40 all the way to $5.70. Let's probably call it that I just bought somewhere around $6. I'll just call it right there. Now, when I did buy this stock specifically, I didn't have as much experience. I didn't have as much information. I didn't know as much as I did know now. So there are some mistakes that I can't say, because I had a good experience with the stock, and it did help me bring home my a pretty big profit in my portfolio on Robinhood. And what I did was I made my first investment. I did have a little bit of diversification with other quantum stocks, but a big portion of my capital went to QBTS. We shot down and we had a little bit of a small decline in my portfolio. And then we did have some good experiences, as I do see here. I was about 60% up, if I recall. I was about $2,000 up, give or take, when we were up here experiencing these highs, and then we shot back down. Now, most people would panic sell in a position that I was in, because when we got to these highs, I did chase the highs and did have some FOMO, and then we shot down, and the losses that were unrealized were bigger than they were before. However, I wasn't too worried about it, because I did have a thesis as to why I did want to get involved with QBTS, and it did work out in my favor. It doesn't always work out, but it did work out in my favor, and I was able to hold strong, which it didn't even feel like I had to hold strong. I was just being patient, just relaxing, and then we came here at around $20 per share, and I sold out with a 200%, give or take roughly about 200% return on my investment, all the way at the highs where I sold off at 200%. So the first mistake that I want to cover is you never know where stock is going to go. So you never want to have too much of your capital into one stock. The second mistake that I want to let you all know about is selling off your entire position too soon. Again, we are not hindsight traders, and you never know where a stock is going to go. However, you want to have the philosophy, especially if you're a long-term investor, even if you have a take profit price, you do want to have some runners in play to let your portfolio grow for the long term, whether if it's to hold for a specific amount of time, or even you just leave it in there forever if it's a stock that you truly believe in for the long term. Because as we do see here, we did get all the way up to the all-time highs at about $46.75. So those are the first two mistakes that I want to let y'all know. The second thing, because I can be guilty of this as well, even now, and real quick to recap of what I just said, again, I did learn from my mistakes, because I do have a more diverse portfolio, and I do have safer investments in my portfolio. And I also have plans for my take profit plans where I only take partial profits and I leave runners for the long term with other investments like Castellum CTM, Big Bear AI, so on and so forth. The second thing, we got to think about the downside, not just the upside. A lot of people only think about the upside because they see a stock and think it could 5x, but you could also be asking, what if this stock drops about 50%? Now, let's talk about a stock that I actually did get out of early, and I did save myself roughly a $3,000 loss. Now, $3,000 to me now is not like super crazy. It's not good. it's not good, and I don't want that. But it would have been a much bigger deal back then. So before the reverse stock split that happened with KULR, I did have a thesis in play, and I did have a reason for being involved with the stock. But just so you do know, I did have the fortune to get out before the bad earnings report they had, where it shot down all the way and they had the reverse stock split. So I did save my money there. But that's why it's important to never marry a stock, because when I first got in, I did like what they were about, the mission they had, how they were heavily involved, invest into Bitcoin, and a bunch of other metrics and a bunch of other things I looked at with their financials and the people in their leadership positions in the board. I looked at all those things. Now, again, due to the help of people that have more experience than me, such as Will Rich, for example, he was mentioning things about how because even before I got involved with Will Rich, or I knew about Will Rich's channel, I did hear Warren Buffett and Charlie Munger talk about how they love to see in the stock report how they talk about when a company is very transparent with the problems and the good things about the company. They had a lot of open-ended things and a lot of things specifically where they wouldn't fully talk about the problems they had, and it did seem a little bit shady. And also, they had too much focus on too many things at once, which is not a good thing for a company, which can actually hurt them. And luckily, again for me, I did get out of the investment before it was too late, and I took roughly a few $100 loss, but I saved myself from losing another $2,000 to $3,000. So that's why it's important to not marry a stock and to always think about not just the upside, but the downside when it comes to the stock. Keep cash ready. This is a big problem that I used to have, and I made the adjustments, because especially when it came to my profits on QBTS, like some investors, they tend to be all in, which is something I did for sure, because when I got in with QBTS and I diversified into my Vanguard brokerage, into the VU, that follows the S&P 500, and my Roth IRAs, and a little bit of crypto. After I did all that, I had roughly, because again, I started with roughly 20,000, and then in savings, I brought it all the way down to about 5. Then after I took my win on QBTS, I pretty much diversified my portfolio into other cheap growth stocks that I really had high hopes for, and I do see a potential for the future of those stocks. And after that, the last remaining amount of money I had in my savings, I pretty much went all in, and I was pretty much just floating below $1,000. I have grown my savings account. I do have an emergency fund, and I have still my safe investments there, but again, it still was a mistake that I made in the past that I don't plan on making again. So it does cause problems, because if you have emergencies, if you have for when you have to pay taxes, a short-term capital gains tax or any tax period, or if you just have any expenses that you need to cover, you don't want to be in a position where it is that you have to sell your stocks in order to cover those expenses. And on top of that, if you don't have any cash on hand, what's going to happen is what's going to happen is you're going to be you're not gonna be able to capitalize on the opportunities when it dips to the downside and you buy in at the lows. You won't be able to take advantage of those opportunities if you don't have any cash on hand. Second off, you gotta balance your risk out. If you're investing in small cap stocks like Castellum CTM, that's fine. There's big upside, but you also do have to look at other safer investments as well, like the S&P 500, for example. And then next, you got to also take a look at dilution. This is especially important for small cap investors, because even if a company looks good, if they keep issuing shares, you as the investor lose value. So always check cash levels, share count over time, and if they rely on raising money, because dilution can quietly destroy your investment. Finally, emotions. This is where most people lose money. Chasing stocks after they run up, panic selling when they drop, holding losers too long. If you can stay disciplined and think long term, you're already ahead of most investors. So, in closing, guys, at the end of the day, long-term investing is about hitting one big winner. It's not about hitting one big winner. It's about avoiding big losses, staying consistent, and letting your money compound over time. That is actually how you build wealth. If you want more videos where we talk about stocks like KULR, QBTS, Big Bear Ag, Castellum CTM, again, please feel free to comment below, as I'd be more than happy to discuss what it is we can do in order to grow as a community and find ways to better ourselves as investors and give the content that you guys want to see. So with that being said, guys, again, InvestQ out. Always happy to be here. Love doing these videos. Stay safe, keep making money, and keep making decisions that are best for your long-term portfolio. See you all in the next video.